Today on Your Money, Your Wealth. Whether you call it the barn door, the garage door, the Roth two-step, you asked for more about the tax-saving Backdoor Roth IRA conversion strategy, and Big Al and, reluctantly, Joe are here to serve, for now at least. They'll discuss whether you should wait until retirement to do a Backdoor Roth conversion, the Pro-Rata rule, self-employed MAGI, that's modified adjusted gross income versus AGI, and how capital gains work with conversions. Then, for a change of pace, the fellows will cap off this episode with how to strategize for if and when the estate planning step-up in basis tax laws change, whether a high-yield savings account is a good option for investing $25,000 in cash, and listener comments. I'm producer Andy Last, and here are the hosts of Your Money, Your Wealth, Joe Anderson, CFP, and Big Al Clopine, CPA.
If you want to join the party, this is what you got to do. You got to go to yourmoneywealth.com, click on Ask Joe in L on the air. You can write a little email, or you can actually ask a question like this gentleman did.
Love the show, Joe and Al. Thanks very much. Calling about Roth rollover or backdoor Roth conversions. My wife and I are 58, planning to work another 5 to 10 years. We're in one of the higher income brackets right now, 24%, and we expect our income to stay high, above $250,000 a year. But 89 to 90% of our retirement assets are in a traditional IRA. That's about $850,000. The question is there any opportunity for us to do a backdoor Roth IRA now, or should we wait until we retire in 5 to 10 years when our income tax bracket will be much lower? And what could we expect as far as longevity of that Roth and the benefits of waiting until that retirement income is much lower? Thank you for taking the question. Keep up the great work. Bye.
Okay, great. Al, I guess he's asking a couple of different things here, right? He's talking about a backdoor Roth IRA and then a Roth conversion, and maybe he's combining the two.
That's what I was thinking too, Joe. But we'll kind of take both.
So a backdoor Roth IRA, for all of you first-time listeners, is that there's income qualifications to put money directly into a Roth as a contribution. So roughly, if you're single, you make over $130,000. You can't directly put money into a Roth, and if you're married, it's about $200,000. So he is over the $200,000 mark, so he cannot directly put money into a Roth IRA as a contribution. So he's thinking, should I do a backdoor Roth IRA conversion? What a backdoor Roth IRA does is that you can put money into a traditional IRA as long as you have earned income, and then you can convert it directly into a Roth IRA with zero taxes because it's an after-tax contribution that has basis. So if he's asking that, yeah, by all means, do those. But what we don't know, Alan, is that how much money does he have in traditional IRAs versus 401ks? Because people use those terms interchangeably.
Well, he actually said, but 89 to 90% of our retirement assets are in a traditional IRA. That's about $850,000.
But I think sometimes people will say, I have money in an IRA, but it's actually a 401k. It could be a 403b. It could be a TSP.
So let's answer both ways. So if it's in an IRA, then the pro-rata rules come into being. And so you do, let's just say 58, so over 50, a $7,000 backdoor Roth. So you do a $7,000 contribution to an IRA, and then you turn around and convert it. Well, the IRS says you got to add the $7,000 to the $850,000 that you already have, even though it's a different IRA. And so now it's the ratio of $7,000 divided by, in this case, $857,000, which will be about 1% or so of that IRA contribution will be tax free. So that's not necessarily a great idea. Although your tax rate is 24%, which isn't too bad. We'll come back to that in a second. Now, if it's all in a 401k, Joe, then it doesn't matter. The 401k dollars are not computed and not considered for purposes of the pro-rata rule.
Yes. So it depends on if it's an IRA versus 401k, but he states an IRA. So a backdoor Roth, if he puts $7,000 in, so you add 7,000 to the 850. So 857,000 divided by 7,000 is 3.7%. So 3.7% of the conversion is going to be tax-free. So I don't know if that's the right answer, or did I do 387,000 or 800?
Yeah, you're off. It's about 1%.
Oh, whatever.
Think about seven.
No, I get it.
7 into 700,000 would be 1%. It's less than that.
7,000. 857
divided by 857.
Yeah, it's about less than 1%. Like I said.
Yeah, like you. That's what you thought. It didn't come out of your mouth that way, but that's okay.
0.8%.
Yeah.
God, it's so hot in here too. It's just like burning up. Andy, this studio is super hot.
I haven't been there in 6 months, Joe. That's on you.
All right, 24% bracket. So 250,000. What's the top of the 24% tax bracket, Alan?
Oh, for a married couple, around 325,000.
Okay, so if he wants to stay in that 24% tax bracket, right? A backdoor Roth is going to give him 7,000, right? Where 80 bips is going to be tax free.
Yeah.
Or he could convert to the top of the 24% tax bracket, which he could convert it an additional, 100 grand.
Yeah.
So I'm not sure what question he's asking, I guess is the point.
Yeah, well, there's a couple, and let me sort of clarify. One of the questions is, should he do something now or after retirement? Well, first of all, a contribution you can only do when you have earned income. So that would be now, not after you retire, unless you or your spouse have some earned income, right? So assuming that you both retire and there's no earned income, you can no longer do a Roth contribution. That's the $6,000 per year, $7,000 a year if you're 50 and older. But a Roth conversion you can do at any time, and that's basically based upon, you can do any amount at any time, working or not, any age. But you have to consider your tax bracket. 24% tax bracket is actually not bad given where tax rates are going and where they may go. So I think that's part of the question is what sort of bracket are you going to be in retirement based upon your fixed income, and you kind of go from there.
Right. I mean, he's going to work for another 10 years. He's 58 years old. They already got $1 million roughly saved in a 401k plan. I don't know. I think tax rates are going to go a lot higher than where they're at today. The 24%, we like a few years ago, the 25% tax bracket was kind of where we would look. The 15 or 25, those were really good brackets to convert. The 24% tax bracket is giant. So he might want to take advantage of that 24% tax bracket. And it's like, well, the longevity, I don't know. He's 58. Let's say he lives another 60, another 20 to 40 years, right? Compounding tax-free. There's a lot of benefits there. But I don't know what his fixed income is going to be in retirement. I don't know how much money he spends. So there's a lot more questions, I guess, that you would want to answer. But in a vacuum, the 24% tax bracket isn't all that bad. I agree with you, Al. So he might want to look at converting, in the bracket, maybe not to the top of it, but at least to get some chips off the table. Al, we got an email in from Stever. That's
when you hang around surfers, I know a few surfers in San Diego, they like to kind of call each other names like Stever or
he lives in Coronado.
Yeah. That's what I'm thinking. It's not the best surfing in San Diego, but there is surfing in Coronado.
Stever. I don't know. If I was named Steve and someone called me Stever, I might slap him in the face.
It might be a typo, you guys. He might have accidentally put that R on the end.
I don't know.
I think
I've been to Coronado. I guaranteed. I think I met Stever.
He was on his shortboard right in the
waist. Well, all right. So here's what he writes. Now, let's just say I drive a Mercedes because I know you care.
I guarantee you. It's not
Stever.
A Mercedes.
Guaranteed, he wrote Stever.
Right.
And he wants to do a 2020 Roth conversion using pre-tax IRA account containing a few Hunsky. Look at the vocabulary in Stever.
So that's why I think he's a surfer. He's already talking surfer lingo.
A few Hunsky.
Hunsky.
All righty. Hunsky to me, I'm not even going to go there. All right. While planning to leave a significant amount in the same IRA. For 2020, I will have wages of $300,000 plus long-term capital gains of around $500,000, which were a payout when the company I worked for sold. I believe I've heard you say that capital gains rest on top of income, but I'm not quite sure what that means. Does it mean capital gains don't count toward my income moving into a higher tax bracket? My wages are usually around $300,000. In 2019, my marginal tax bracket was 24%, but I had very little capital gains. I'm married, finally jointly, and over 60, and starting to think about RMDs in the related tax rates. Although I'm a bit concerned I might end up in the 32% tax bracket if or when I convert portions of the IRA, I'm questioning if it might be worth the tax hit even at the higher tax bracket, given the historical stock market average gains around 10%. I've never heard you recommend converting at the 32%, but I'm pretty convinced tax rates are going up. And when I take an RMD, they will be significantly higher than the 24% tax bracket I'm in today. I'm interested in your opinions. If you think it might make sense to convert to the 32% rate, since the minimum time I expect to have a Roth is going to be over 5 years where I start chipping away at it. Thanks for your thoughts in a very entertaining program. Stever, couple Hunsky in the old IRA, cruising around in a Mercedes.
A few Hunsky. You think it's probably like I'm going to guess about a 1998 Mercedes, maybe a diesel.
Definitely diesel. Okay. Well, I like his question here. So let's first start. Explain again, Alan. So his wages is $300,000. He's got a big capital gain this year of $500,000. So he's like, okay, the capital gain sits on top. Does that mean
what does that mean? Right. So let's start there. So Stever, you're at $300,000 of income. And if you just do the standard deduction for a married couple, it's about $25,000. So your taxable income is about $275,000. We just mentioned the top of the 24% bracket is about $325,000. So actually, I'm ignoring the capital gains to start, Joe. I'm just going to do the ordinary income. So Stever could do a $50,000 Roth conversion roughly and still stay in the 24% bracket. So you figure out the ordinary income rate first before you look at capital gains. That's why I say they sit on top of. So you go through that calculation. You got about $50,000 of room, Stever, in the 24% bracket. I'm gonna correct myself. Anyway, now capital gains. Capital gains in roughly once you get over about $500,000 of income, they go from 15% tax rate to 20%. So this Roth conversion, if you did it, the $50,000 would be taxed at 24%, but it would also push your $50,000 more of capital gains into the higher 20% rate. So that's a 5% delta. So you'd have another 5% tax on the capital gains. So really it's not 24, it's 29% tax rate when you think of it that way. And then, of course, you got state tax on top of that, which in California, given these amounts, probably is 10.3 or even probably 10.3%. So you another 10%. So you're close to 40%. It's kind of that's getting a little expensive, I think, to do a Roth conversion. I might wait until you don't have the big capital gain, so you don't have that extra tax, that extra capital gains tax. But that's how you calculate this. You calculate ordinary income tax first, and then you see what the capital gains taxes are. Because you have more ordinary income tax, it means your capital gains got pushed into a higher bracket for the capital gains side.
Yeah, but I think the question there too is, how much money does he have in retirement accounts that he wants to convert? Right? We really don't know what that is, because if he's got millions and he's got a fixed income, let's say a large pension, he's chilling in Coronado, right? So the bracket might be a lot higher in the future for him, depending on what his other fixed income sources are and how much money that he has and what the RMDs are going to be and so on. But I agree with you. Just with the information we have, 40% seems a little bit rich. But we have recommended converting in the 32% bracket. We've recommended converting in the 37% bracket, just because of the amount of money that someone has and where we projected their taxes going to be in the future.
Yeah, and that's typically based upon someone that it feels tax rates are going up, which we tend to believe as well.
Joe and Big Al did a webinar on taxes last week, specifically for clients of Pure Financial Advisors, but then they decided it was so good they wanted everyone else to see it too. Click the link in the description of today's episode in your podcast app to go to the show notes at yourmoneyyourwealth.com to watch. You'll find out why the timing might be right for tax changes and how provisions from the Tax Cuts and Jobs Act of 2017, the CARES Act coronavirus stimulus package, and the Secure Act affect your taxes and retirement planning. Most importantly, you'll learn how strategies like the Backdoor Roth IRA, tax loss harvesting, and tax gain harvesting, and beyond can help you to legally minimize how much you owe in tax. Share the webinar with everyone you know, and click Ask Joe and Al on air there in the podcast show notes to send in your money questions.
Let's go with Jason from St. Paul, Minnesota. Right next to the Robbinsdale, Minnesota is where I grew up and was born. Just for those of you taking score there.
Yeah, and you go back, every other year or so?
Yeah. I have
less.
Well, actually, I don't know. It depends. I guess if there's a funeral or a wedding,
yeah,
then I'll go. But yeah, my mom now lives in Maple Grove.
Right.
So
which, I don't know where that is. I assume
haven't been to Minnesota. I haven't been to Robbinsdale lately.
Yeah.
Jason's from St. Paul, which is kind of a rival city for Minneapolis, but it's the Twin Cities, Alan. Just
sure.
Just to help you.
Yeah, I did know that. Yeah.
Got it.
The Minnesota Twins.
Yep. Hello, Andy, Joe, and Big Al. Love the show. Recently found the podcast in avid listener. Well, recently. All right. New listener. I learn something new every time I listen and feel that you are helping me and my wife be in a better financial position when I choose to retire. I mean, do you think Jason is chilling in St. Paul with his wife and this stupid podcast is like on a speakerphone or Alexa? Yeah. They're just
I think they're out running an errand. He's got the show on, and she's going, "Oh, honey, come on."
She's like, "This is awful." Or do you think they're like, "Oh, wow, I hope they talk about Roths."
I think
for the next couple of episodes, and then that's it.
I think he's buttering us up a little bit. So we'll answer the question.
I got it. All right. I have a question about doing backdoor Roth conversions in the Pro-Rata rule. My wife and I each have about $40,000 in traditional IRAs and a financial service company, Equitable, formerly AXA. We both rolled our 403B to this IRA when we left our old company many years ago. My wife also recently left her previous employee and left her 401k money there under Fidelity's retirement plan. We are not allowed to contribute to Roth directly because we are over the income limits in considering annual backdoor Roths of the maximum allowable contribution amount. I've read we need to roll the traditional IRA to our current 401k before doing contribution conversion to avoid pro rata. What about the RSP? Is that still a 401k and are not calculated in the pro rata calculation? Lastly, is there any time backdoor Roth is not worth it? We are just barely in the 32% tax bracket, and we expect our incomes to continue to grow over the years. We are 38 years old and would love to be FI. Oh, I guarantee they sit around and listen to this garbage. He uses FI. It's financial independent.
Financial independence. Oftentimes, one spouse is more into it than the other. I'm going to guess it's Jason.
Sounds like it's Jason.
I don't know if you think, hey, honey, can't wait for FI.
Now he's 38. Shouldn't usually when you start talking FI, you start saying 40.
Yeah.
Or 42.
Well, Jason,
45 at the latest.
He's a brand new listener, Al. If he was listening like 10 years ago, he would have been FI.
He'd already be there.
He'd already be there. We currently spend less than what we make in retirement. Do not expect to need the same amount of household net income as we make today. We each max out our pre-tax 401k contributions. Her hitting federal limit and me highly compensated limit. Ooh, HCE. We also max HSA and contribute to the 529. Please keep up the great work and energy you bring to each show. Thanks for all you do. Yes, derails get my belly laughing at times. Yeah. Belly
Thank you,
laughing.
Jason.
Belly laughing. Okay, so Fidelity Retirement Savings Plan. That's
what RSP stands for. Yeah.
Yes, I understand. I got it.
I was telling the listeners because you're like in the lingo and just jumping right over what RSP is.
Yeah,
He's just reading it.
I'm just reading Fidelity Retirement Savings Plan. Yeah, I would first talk to Fidelity Retirement Savings Plan, talk to the HR and say, hey, can I get the paperwork to roll an IRA into my Fidelity Retirement Savings Plan? The problem, though, with this, Al, is that she doesn't work there anymore, right? So I don't know where Jason's wife lives because she's hanging out with them, listening to this, talking about FI. You would have to roll the RSP into the 401k plan. We are not allowed to contribute to the Roth directly because of the income. My wife and I each have 40K in a traditional IRA. I don't know. Maybe the wife's not working. But,
yeah. Well, if she is working and she does have another 401k plan that allows rollovers into it, then she could do that.
Yeah. If not, keep it in the RSP because then that would be the same as the 401k. That would not be included in the pro-rata rules. So roll or maybe Jason, because you're young, just blow out her. If she doesn't have another retirement account to do the backdoor Roth for her, take the 40K and convert it, bite the bullet, pay the tax, right? And then if she's not working or have earned income, she can still make a non-deductible IRA contribution and convert that each year as a spousal contribution. So just because one spouse isn't working doesn't mean that that spouse still can't contribute. So I don't know if I missed something in translation, but I didn't see that she had a job, but they are both making good money. So I don't know if she has another 401k, move it into that. If not, keep it there, and then chip away at the IRA. So, all right, Jason, thanks a lot for becoming a new listener. You know, there's something that's called a review. I don't know if you guys are familiar, but I don't know anything about it. Compliance doesn't really let me talk about it, and since I can't talk about it, Santiago writes in. He's 53 from Columbia City, Indiana. I'm a new listener to the show, and you all have become the show I must look forward to. Oh, look at Santiago. Thank you. Thanks for the awesome content, Ken. All right, so here's the question. Can you use a backdoor Roth? God, are we the Backdoor Roth IRA show?
Now you are.
We talk about it, I guess, a lot. It's because people ask about it.
I'm not answering any more backdoor Roths. Santiago, I'm sorry. This is not this is not your the show that you're going to look forward to anymore. Okay, can you use backdoor Roths and exceed the $7,000 limit if you make less than the married filing jointly cut off for Roth eligibility? Thanks again. I appreciate your time. So I don't really understand Santiago's question here. So let's see. Can you exceed the $7,000 limit if you make less? What do you think?
The answer is no. You can $7,000 is the most you can put in when you're 50. But I'll say it this way: Santiago apparently is married, so his spouse could put in $7,000. So actually, could they jointly, as long as she's 50 and older, maybe she's in her 40s, I don't know. So if 40s or younger, 49 or younger, it's going to be $6,000, 50 and above, it's $7,000. So they can do that as a couple, but you can't double up on a Roth conversion just because you did a backdoor Roth, if that's what he's asking.
I don't know what he's asking.
I think you might be confusing the Roth contribution with what a backdoor Roth conversion is.
Well, it's the same thing.
Yeah, it's just a way to make a Roth. It's a way to make a Roth contribution when you're over the income limits.
It's Roth contribution with an extra step.
Yep, that's really what it is.
So let's just start calling it that.
Roth contribution with an extra step?
Yeah, I think I like that a lot better than backdoor Roth.
Don't some people call it the Roth two-step?
Well, I think you do, Andy.
Yeah, I like that. That's even better. The Roth two-step.
Because he can convert as much as he wants out of an IRA. So I don't care how much money Santiago has. He can. The limit for conversion is unlimited. The amount that you can put into any IRA, Roth or traditional, is $6,000. He's over 50, so it's $7,000. If he wants to make a non-deductible IRA contribution, if he's over the income limits for a Roth IRA, he can make $7,000. His wife can make $7,000. He could convert both of those dollars and any additional retirement dollars that he has. The taxation of the conversion is going to be dependent on the pro-rata basis that he has within the IRAs. So hopefully that helps, Santiago. Thank you for your first question, even though it wasn't that great. David from San Diego writes in, hello to all three. Having the three of you chime in while you're all answering questions is definitely entertaining. I've listened to many financial shows, and while I check in on those other shows once in a while, I listen to you every Tuesday when your podcast episode is released. That said, I figured I would send you a question that was not Backdoor Roth related. Thank you so much, David. I can't tell you how much I appreciate this. As it seems to be a too frequent topic on your show, and I think your show is the best when you show off your respective knowledge on a variety of topics. Well, see, we're not just a one
trick pony.
Yeah, thank you. One trick pony. So hopefully my questions stimulates a different discussion. Now, I guarantee I have no idea how to answer this question. Okay, Joe and Al, I have... God.
Joe and Al have helped me understand.
Oh, thank you very much, Andy. Joe and Al have helped me understand my philosophy. He's just like talking to a group of people here.
Right.
Like he's hosting the show. What the hell do you need me for? I thought he's asking me a question, but he's talking to the group.
I think we get one eventually. May not finish it for this segment, though.
Yeah.
Yeah, I mean, he wrote 4 pages here. All right. Joe and Al have helped me understand my philosophy on how I wish to retire. Mainly, that I want to pay as little in taxes from tax-deferred retirement accounts, and that my comfort is with paying taxes now and withdrawing from Roth accounts later. 100% agree. With Al, that I will not miss or feel the tax savings in the future. That has already changed my life. Truly, thank you. I've become self-employed last year and contribute $19,000 max for 2019 in a self-employed Roth 401k account I started thanks to your show. And I will be doing the same for 2020 because my clients paid me for 2019 work in 2020, and because I recently landed a client that will pay me a greater retainer fee and will pay on time. Well, there you go. My income this year, 2020, will be about $160,000 after minor deductions for the business. My spouse has a salary, stable employment of $80,000 for the year, and contributing on a pre-tax basis to the 401k. She's maxing it out, so her income will roughly be $61,000. My understanding is that with a $221,000 combined income as a married family joint will not allow us to contribute to Roth IRA. I know that my wife could contribute to Roth 401k, but given the uncertainty of the year, we did not expect to cross the threshold for Roth IRA MAGI income levels. I'm having trouble understanding the difference between calculating MAGI and AGI and have looked around a lot with no luck. I'm hoping you could talk about what obvious deductions exist, are allowed to reduce our modified adjusted gross income that would make it possible to contribute to Roth IRA for 2020. I have very few business expenses that are basic utilities like phone and internet. I work from home, small 25 square foot place. Insurance like errors and emissions and professional liability as I'm a service, not selling products. My wife has health care through work, so no expenses there. Can I pay for life insurance through my company and deduct it through the modified adjusted gross income? Can I pay for the advertisement and send out Christmas cards and deduct that? Any suggestions or leads to more information would greatly be appreciated. Luckily, I have not made those Roth contributions, so do not have to worry about taking the money out. Thank you in advance in considering my question as part of your awesome show. This guy should do a backdoor Roth IRA. I swear to God. After all this, he's like, you know,
I'm not going to ask about it, but maybe that's what I need to do.
I know. It's like, I don't want to ask about it. The show sucks because it's the Backdoor Roth IRA show. I'm all excited because I thought he's going to ask us something that he wants to put money into a Roth. He makes more money than the allowable limit He's got a 401k. His wife's got a 401k. He wants to make a Roth contribution. The guy's a prime candidate for a backdoor Roth.
Here, I've got another approach, Joe.
I swear, right?
Well, yeah, but listen to this. So he's self-employed, and he's only talking about the employee contribution, 19,000. You can also put in about 25% of the profit, and it's not quite that simple, but we'll just go with that number, right? So 25% of the profit, let's just say it's at 150, because you got to deduct the self-employment tax, half of that on that. So anyway, it'd be roughly $37,000 that he could deduct on the employer side. That could be a straight deduction. So there you just, that alone gets him down below the Roth contribution limit. Or if he doesn't like that idea, he can certainly buy the Christmas cards or prepay anything for that matter in his business, get the deduction this year, because most businesses are cash basis. So it's when you pay for something that it's deductible. You have to do it within reason, though. They'll allow you to deduct maybe 1 month of rent, but not 2 or 3. You know, in terms of supplies, maybe a month or 2 of supplies, but not a whole year. So just be careful there.
Yeah, he could buy a bunch of gifts too for his clients, right? And deduct that.
Could, but there's a $25 limit on gifts. So people tend to call those promotion instead of gifts to get around that rule. You didn't hear it from me.
All right. Okay.
Just an observation I've seen.
Got it. Yeah, we're a couple of kids who's talking taxes.
Check the podcast show notes for more free Backdoor Roth resources. You can read our blog, which dives deeper into the nuts and bolts of the strategy, and you can listen to previous YMYW episodes that answer even more Backdoor Roth questions. Then, download the 2020 Tax Planning Guide. You'll get important tax deadlines, the 2020 tax brackets, issues and updates for the year, tax strategies, and actions you can take. Click the link in the description of today's episode in your podcast app to go to the show notes at yourmoneyyourwealth.com to access all of these free resources. And don't forget to hit the share button and send this bad boy out via email or on social media to everybody you know.
We got Charles in Folsom, California.
Isn't that where there's a prison?
That's Johnny Cash, my friend.
Yeah, right.
Yeah. Yes. Love Johnny Cash. So
Folsom, makes 2 of us.
Folsom Prison. He shot a man in Reno.
Just to watch him die.
There you go. Good boy.
Yeah, that's tough. Always wore black.
Yes, sir.
Tough guy.
Hi, Joe, Al, and Andy. Thanks for everything that you do. I started listening to your podcast earlier this year and haven't missed one since. All right. My question, I'm concerned about potential tax property changes coming if Biden wins, especially when it comes to the loss of stepped up basis on an inherited home. My parents' Bay Area home is worth $1.5 million. They paid $400,000 for it. My parents are in their late 80s and are in good health. Are there any actions my 3 siblings and I can take now to avoid this potential tax burden? Create some sort of trust, maybe have my parents deed us the house now, and of course, continue to let them live there so we can get the stepped up basis before the law changes. There must be something creative and legal we should be considering, right? I don't want to end up in Folsom Prison for tax avoidance, evasion. So be gentle, guys. I can see the prison walls from the corner of our upstairs balcony. So it's a constant reminder to follow the law. Thanks, Charles in Folsom, not inside the prison.
Okay, well, good. I'm glad we clarified that.
Oh, that's awesome. What would you like that for a view? Get up in the morning, get a little cup of coffee, open up your bedroom window, and just look at the prison.
It's like,
now, that's a way to start your day.
Honey, I'm doing my taxes. We're going to stretch on the contributions. Wait okay, never mind. We're going to be honest. In fact, I'm not even going to count half of them.
Oh, man. All right. So a couple of things. So let's first talk about stepped up in basis. So his parents got a $1.5 million home in the Bay Area. They paid $400,000 for it. So if there is no step up in basis, and let's say Charles inherits that home, he's got a 1.1, him and his siblings have a $1.1 million gain in the house because they bought it for $400,000. They sell it for 1.5. 1.1 is the actual capital gain. But however, how the law sits today is that if they inherit that house, their basis changes from 400,000 to 1.5. So at the date of death, the benefactors, the inheritors, then take the basis of the deceased, or they take their own basis at the date of death of the deceased. So they died, it's worth $1.5 million. Now that is Charles and his siblings' basis. They sell it the next day, zero tax due. So Charles is thinking, okay, well, if they get rid of stepped up and cost basis, my siblings and I are going to pay a bunch of tax. And how do I go about doing the appropriate planning that I can avoid at least some of the tax burden without putting himself inside Folsom Prison?
I think that's a good summary.
Okay. So can you create some sort of trust? So there's not for the stepped up in basis for estate taxes. So there's two different taxes there too at death, depending on the size of the state. So if there's an estate tax, you could do like an estate freeze, but that doesn't really help the basis issue.
No, it doesn't. And yeah, so let's just start right there. So if you set up a trust or you do any kind of transfer, absent a sale, right? Absent a sale, then it just goes over at the same basis, right? It's a transfer into a trust, transfer to the kids. It goes over as the parents' basis. To get a stepped up in basis while your parents are living, they'd have to sell it, right? Which is a possibility. They could sell. They've lived in it presumably 2 out of the last 5 years. They get a $500,000 exclusion, and they only pay tax on $600,000. But Joe, I think the bigger issue is there going to be a change in estate taxes? Because Biden did mention maybe we'll get rid of estate taxes and get rid of the step up in basis. That's why we have step up in basis, because if you have to pay an estate tax, you shouldn't have to pay a capital gain at the same time. Now the estate tax exemption is so high that almost everybody or almost nobody pays estate tax, but we all get a step up in basis. So yes, Biden did talk about that. Will that possibly go through? Very doubtful. I mean, anything's possible, but this would have to be gone through Congress and the Senate, and the president passed into law. Very, very unlikely. And I'll tell you why. It's because it'll affect mom and pop and everybody else, not just the wealthy. It affects everybody. So the likelihood of this happening to me is 1%. So I wouldn't, and I would say this generally about tax proposals from presidential candidates or any other kind of candidates for that matter. They're just discussion points. Don't think that they're going to be lots. It's hardly anything happens based upon what people say.
Right. Couple things too to note. If there's a gift, right? So let's say mom and dad gifted the property to Charles. Well, a gift, you keep mom and dad's basis. So just remember that as well. So sometimes it's like, well, here, let me gift this out or put you on title. You very rarely do you want to do that. So anyway, Charles, thanks so much for the question, and stay out of jail. Roberto writes in, hi there. I have $25,000 in the bank. Would appreciate your advice on how to proceed in investing or how I can get the most out of it. I hear it a high yield savings account. Please advise. What do you think, Al? Roberto, keep the money. I don't know. Go to a high yield savings account.
There's a couple more things we need to know. Like, what's the money for? When are you going to need it? How old are you? What are your other accounts? A whole variety of things to help you figure out how to invest something. But if I just look at this in a bubble, you could go probably to your credit union. I don't know what they're currently paying, 0.6, 0.8. It's better than 0, but not much more. A high yield savings account, I'm not really quite sure what he's referring to, but I don't think you'll find anything more in a savings vehicle any more than about 1%, if that, right now.
Yeah, we need a little bit more information. We don't advise on this show, Roberto. Once again, thank you all for your questions and comments. I really appreciate it. Enjoy the comments we get, the reviews. What are they called?
Comments.
Comments, yes, comments. Jake, Boston, Massachusetts. YMYW is a great financial podcast. It never grows old. Definitely worthy of 5 stars and more. And he does a great job keeping Joe and Big Al on track. The show is informative as well as entertaining, and the derails can't be missed. I usually listen while I'm walking, and it makes the miles go by quickly. Keep up the great work. A loyal listener from Boston. Thanks, Jake, from Boston, Massachusetts. I was going to read something here. Judy from San Diego writes in. She's like, you were right. It's pronounced Islip.
She was saying that to me.
Oh, named from the canals of Long Island that are shaped like a capital
I,
with a bar across the top. I grew up there. Islip.
Yep.
I got it.
What did you say?
Islip.
Islip?
Yep.
Got it.
Hello, I'm a big fan. This is from Phil, writes in. Hello, I'm a big fan of the YMYW podcast. Your host botched the pronunciation of Islip.
Wait a minute. Only one host botched it. No, I didn't say anything.
Please tell Joe and Big Al, that it's pronounced East Islip. Thanks. And keep up the great show. So is it East? It's East Islip.
Islip, yes.
East Islip. 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 There you go.
Or I slip.
It
Islip.
could be I slip or I slip.
But it's not Islip.
One Judy said it's I slip, and Phil said it's ice lip.
Mm-hmm.
So we have a difference in opinion there too.
Yeah. I don't know. Just
No one knows what to say on this one.
Well, Judy says she's from there, so I trust her.
Got it.
Got it. All right. Well, thank you very much for I botched.
Yeah, Joe and Big Al.
Yeah. Like you botched your email, Phil. Oh God.
Oh boy.
Tom from Texas writes in, hey, was listening to our fire YouTube video. And so Al and I did a TV show on the fire movement. And then you mentioned this movement started with millennials. I don't think we ever said it started with the millennials. I think saving money started probably 1,000 years ago. But maybe we said it's...
I may have said something like... It sort of caught on with the millennials. I don't know. I don't remember what I said.
Yeah, you probably said it started with the millennials.
It's on tape, so it's probably, Tom's probably right.
Whatever I said.
Yep, this idea or concept, as I'm sure you agree, has been around much longer than the millennials have been alive. It's like Tom is pissed off here.
Apparently.
God, I hate the millennials. I can't believe you gave them credit for that.
It was my idea.
It was my idea. God, the benefit they have over prior generations is technology. So they're the lucky bastards that got technology that can leverage. He goes, I own 30-year-old books. He's got books older than these millennials that are worth more than these millennials will ever have.
That's not what it
Tom,
does.
calm down. Jeez. Settle down. So, Tom's living the dream. He said he's been living fire on 30% of gross income for decades. So, Tom needs some credit. Tom, you're part of the fire movement. Thank you for your... Yeah. He's on fire.
He's one of the early pioneers, I think.
Yeah, cantankerous. He's in his 50s and he sounds like he's 70. I got underwear older than these damn millennials.
It does seem you get more crotchety as you get older.
Tom's in Texas. Texas is a nice place.
You know? Yeah. They get fired up there in Texas, don't they?
Thank you all for your feedback. We love hearing what you think. And Jason, Jake, and all the other fans of the Derails, we got a couple shorties waiting for you at the end of today's episode. Your Money, Your Wealth is presented by Pure Financial Advisors. Click the Get an Assessment button in the podcast show notes at yourmoneyyourwealth.com or call 888-994-6257 for your free financial assessment. That's 888-994-6257. Pure Financial Advisors is a registered investment advisor. This show does not intend to provide personalized investment advice through this broadcast and does not represent that the securities or services discussed are suitable for any investor. Investors are advised not to rely on any information contained in the broadcast in the process of making a full and informed investment decision.
My name's Joe Anderson. I'm a certified financial
Planner. You're a planner.
planner. That's what
You're
I
going to say, what, pruner?
I don't know.
You like to
what
prune bushes?
I don't know. Today, I don't know.
Certified financial pruner.
I might go there.
I prune your expenses, and that way you end up having the lifestyle you want. Of course, you
I'm
can't
done.
spend anything because I've already pruned them.
Yeah, I'm just
I
gonna be
say,
like
Val.
I'm gonna be a green thumb, Al. I'm just gonna hang out in the garden.
I think so.
Oh, I watched that
Sometimes.
Netflix, that one show with the guy that killed his wife and kids. I don't recommend that.
Was that in Texas?
No, it wasn't. It was in Colorado.
Yeah.
I remember seeing that on the news. What's it? It was like murder in the hometown or something like that. You guys haven't heard of this?
No.
Oh,
No.
yeah. So the guy, lost some weight, got all ripped and cut, and then started dating this little hottie on the side. And then next thing you know, he wants to break it up with the wife, and she probably said no. So instead of divorce, he kills her. So, sorry, spoiler alert.
Don't watch the show. That's the conclusion.
Spoiler.
And on that happy note,
Yeah, it doesn't end happily.